Silver is sitting at 93.72, up 6.61 on the day, a clean 7.59% surge that most retail traders are calling a breakout. They are wrong. This is not a breakout. This is a trap being set in real time. And the data on screen right now tells you exactly how it works if you know how to read it. Let's start with what the numbers are actually saying. A 7.59% single-day move in silver is not normal price discovery. That is acceleration. That is the kind of vertical displacement that happens when a large player needs retail participation to offload a position, or when algorithmic systems are deliberately running price into a cluster of resting orders above a key structural level. The 30-day performance shows a decline of 27.39, down 23.92%. Read that again. Over the last 30 days, silver has shed nearly a quarter of its value. And now on a single session, it rips 7.59% higher. The retail mind sees recovery, the institutional mind sees liquidity being manufactured. The 6-month figure tells a deeper story. Silver is up 48 towards 04 in 6 months, roughly 192.99%. The 1-year number is even more extreme at plus 55.98, which translates to 179.63%. These are not the performance figures of a suppressed metal quietly finding fair value. These are the footprints of a prolonged accumulation campaign that has been running for over a year, periodically shaken out with violent drawdowns like that 30-day decline, each one designed to flush weak hands before the next leg higher. The 5-year gain of 60.58 and the 20-year gain of 77.36 put the longer arc in perspective. Whoever has been accumulating this asset across the last 2 decades is not selling today. They are not selling this week. What they are doing right now with this 7.59% candle is something far more calculated. Now look at where retail traders are positioned right now. After 23.92% decline over 30 days, the majority of retail participants who bought the 6-month or 1-year narrative have stop losses clustered just below the recent swing lows. That is simply how most traders manage risk after a drawdown of that magnitude. They place stops beneath the most recent structural low, hoping the recovery holds. Institutional order flow knows exactly where those stops are. It does not guess. It calculates. The algorithms that move this market are not reacting to news or sentiment. They are executing against a map of resting liquidity that is updated in real time from order book data that retail traders will never see. The 7.59% move today has almost certainly cleared a significant layer of that overhead liquidity, the sell stops and short positions that were sitting above the recent range. This is a classic liquidity sweep. Price runs up, triggers short positions and breakout buy orders simultaneously, and in doing so, it creates the fuel for either a genuine continuation or a vicious reversal. Which one happens next is not random, it is structural. The question you have to ask is whether the move today closed above a meaningful order block or simply wicked through it. Based purely on the trajectory visible in this data, silver has been carving out a compression pattern across the 30-day decline. That compression, after a sustained 6-month and 1-year rally, is precisely the kind of structure where institutional players reload. The drawdown from the 6-month highs was not a trend reversal. It was a retracement into a discount zone, and the 7.59% move today suggests that the discount buying is complete and that price is now being driven back toward premium territory to facilitate distribution or to confirm a genuine breakout beyond prior highs. The fair value gap created by today's aggressive move is significant. When price moves 7.59% in a single session, it leaves behind an imbalance in the order book, a zone where buy and sell orders were never properly matched because price moved through too quickly. That gap acts like a magnet. Price will almost always return to fill it before making its next decisive move. This means that even if you believe in the bullish long-term case for silver, which the 122% 6-month and 179% 1-year data certainly supports, the next 24 to 72 hours carry a very specific risk. The London session and the New York Open are the 2 windows where institutional algorithms are most active, and both sessions have a well-documented tendency to reverse the previous session as aggressive moves before continuing in the original direction. If price sweeps back toward the origin of today's move, the area where the surge began and holds that level as support, the structure would then point toward a continuation targeting the next premium liquidity zone above the current 93.72 print. But if price fails to hold and breaks back below the pre-surge structure, the algorithmic target becomes the next major liquidity pool below, where the remainder of those retail stop losses from the 30-day decline are still sitting. That would be the second shakeout in 30 days, and it would be brutal. Now consider gold running alongside this. The 20-year silver gain of 77.36 versus the multi-decade trajectory of gold tells you that silver remains the more volatile, more manipulable of the two. The big players know this. They use silver's thinner market to manufacture moves that trigger maximum retail participation before extracting that liquidity. The setup right now is simple, and it is cold. You have a metal that fell nearly 24% in 30 days, then ripped 7.59% in a single session. You have a fair value gap sitting below current price that price will almost certainly revisit. You have a London session opening into an overextended intraday move. And you have retail traders who missed the entire 30-day decline, now rushing to buy the recovery at the worst possible entry point. The algorithms already know where this ends.